I think that we are in a phase where volatility and uncertainty are keeping markets contained below levels where they should ultimately price given the regulatory and macro backdrop. That's why I'm excited to buy crypto at current prices, because I think the volatility is short term, it will fade, and the long-term fundamentals will continue to improve.
This episode is brought to you by Kraken OTC. Get access to 24/7 trading services for high net worth individuals and institutional clients to execute orders over $50,000. You'll hear more about them later in the show. As always, investments in blockchain technology involve risk, terms, and conditions apply.
Welcome back, everyone, to another episode of 1000X. We are here today, kind of a boring week since we last talked. Markets come off a little bit, still trading above that 100,000 level, which Joan and I mentioned last time is reasonably significant. But I know things overall are looking like we're in a range. I start to get nervous about a breakdown if we lose 100K. I will say that this type of move here generally signals the end of a run. So I'm definitely a little bit more nervous about the market now than I was a week ago, 2 weeks ago, 3 weeks ago. And definitely, basically we got bullish. We got bullish at like 83. That's when we were like, all right, put all your fucking chips on the table. Let's go up. And then at around 95 to 97, I started getting a little bit cautious. I was like, okay, time to take some chips off the table and then just let the rest ride. And then last week we were talking about how fucking amazing everything looks. But now, we've basically been down since May 23rd. And we just keep making these lower highs on a daily time frame, which to me suggests, okay, maybe we need a breather. Maybe we need to go back down to 93 or something. We'll see how we react at 100. But I'm definitely not. Let's put it like this: I'm not taking any levered longs right now.
Yeah, I think that's what people got wrong. We talked about this on the last episode. Like, yes, the setup looks amazing. The fundamentals look amazing. Pretty much everything the backdrop is setting up for a pretty spectacular rally. I still think it's going to push to 120 or 150. Maybe we get a really crazy, amazing summer. But we also did say on the last episode that there was, cause for concern when it comes to leverage. People were deciding to put all their chips on the table with prices on the highs. That's not what you're supposed to do. You're supposed to buy low and sell high, or at least just buy low and hold on for dear life. And it feels like people were adding exposure that maybe they couldn't manage on the highs. I hate looking at other people's P&L, but one very prominent leverage trader got levered long on the highs and blew up. I'm sure that guy is emblematic of many smaller traders in the space. You can see it. I think before we hit record, you were talking about basis, which is one way of assessing leverage in the market. High basis means high leverage. Low basis means fewer people are, invested heavily in risk that they don't necessarily have capital to backstop. And you know what? Like we called this shot. We specifically said it's a terrible idea to borrow money to get longer than you've ever been when the prices are higher than they've ever been. That just seems dumb. So I don't think we're going back down through 100K. I've been wrong before, but I don't think we're going to just like break down. I think basically what happened between May 23rd and today is people basically setting auto liquidations, basically stops for themselves intolerably close to where spot is trading and getting liquidated. I think what we're looking at, this pullback is, but maybe the rally up to 112 was noise because it was just people buying on leverage, and maybe the unwind back down to 104 was the unwind of that leverage. And this is probably a decent equilibrium level. I still think that still think the fundamentals will continue to improve. So, and I still think that there will be a
And
steady
by
trickle of
fundamentals
inflows.
improving, you mean price go up? Because the fundamentals of Bitcoin are the price.
Not just the price. I mean, like there's, yes, obviously momentum is one thing that in this market matters. You could call it a fundamental. I would call it a technical. By fundamentals, what I mean is like general macro backdrop, legislative accommodation for crypto, not just in the US, but globally, stock and flow dynamics of miner selling. I guess that's a function of hash rate, cost of power, all this other stuff. Bitcoin competes with AI now. It's much more expensive to mine Bitcoin. So miners will shut off at theoretically higher price levels, higher lows than before. Other fundamentals you could talk about include, just like whether or not Bitcoin's considered the degree to which Bitcoin's considered an appropriate portfolio hedge or portfolio allocation for RIAs and private wealth. Those are fundamentals, and I think that all of those are just on the march towards steady improvement for Bitcoin. So that's kind of what I meant by the fundamental picture. Sorry if I wasn't being clear.
I was making a joke, but then you went on such a good rant about how to actually think about the fundamentals of Bitcoin. I didn't want to interrupt and tell you that was just a silly little joke. So that was good, Jonah. I think you outlined it really nicely. what the actual fundamentals are. I mean, I also think one thing to look at is also you have to figure out. I think as we move forward, Bitcoin adoption outside of the US is going to become more important because the US is becoming this known quantity in some way. And a lot of the talk in the beginning was, there's some game theory here. If the US adopts Bitcoin, then that's going to force a lot of other countries to adopt Bitcoin. And I think so. I mean, at least, partially my buying was in response to that. It's like, yeah, I think that's actually probably true. Is that if the US leads on Bitcoin, then other countries are going to follow. What I didn't quite grasp is how much the rest of the world absolutely abhors everything that Trump does, and how much he's politicized the issue of crypto to the point where other countries are actually, like Europe is like, no, we're not going to touch this thing because our constituents don't like Trump and they associate Trump with crypto.
Yeah.
So I think it can come later. Once maybe after a year, if things calm down with all of these tariffs and crazy shit that he's trying to do, if things calm down a bit, then maybe people start to move in other countries. But that's another thing I'm looking closely at is there movement across the pond? Is there movement in Asia, right?
There's movement south of the Rio Grande, actually. Breaking news.
That is true.
Panama fast tracks Bitcoin integration. They're going some sort of new, I haven't really dug into the law yet. It hit basically yesterday, but the Panamanian government's kind of integrating Bitcoin into their payment systems and legitimizing it, making it part of their economy. I think it's basically, to sum up my previous rant, I think the rally to 112 and the pullback to 104 is technical. And I think that the fundamentals are steadily improving. You could say slowly, but fast enough that I would feel weird like selling Bitcoin here to try and buy it back below 100K. I would be more worried about us just ranging for a while and then it running away from me. If I sold exposure that I want over the long run to try and create a short-term profit opportunity, I'd be afraid of missing the train. But that is my bias, and it has been for the duration of this cycle. So take what I say with a grain of salt. I think altcoins, yeah, I mean they're not pulling back like we're in a bear market or like the setup is bad or like people are panicking. I think the general sentiment is still greed.
When executing large crypto orders, discretion and efficiency are key. Kraken OTC is built for high net worth individuals and institutions who need deep liquidity, seamless settlement, and 24/7 access to expert traders. Trade via chat or request fast, automated quotes for orders over $50,000. Visit kraken.com/blockworks to learn more. Availability of products may vary by jurisdiction, not investment advice. Crypto trading involves risk of loss and is offered to U.S. customers through Payward Interactive. View legal disclosures at kraken.com/legal/disclosures. WalletConnect is the connectivity network shaping the future of on-chain UX. If you've connected to a Web3 app, you've seen WalletConnect, an icon of trust in crypto, as recognizable as Visa at checkout. From DeFi to NFTs, swaps to staking, WalletConnect is the backbone of connectivity in the on-chain economy, seamlessly bridging wallets, apps, and blockchains. Over 250 million connections and 40 million users worldwide have trusted WalletConnect. And now, with the launch of the WalletConnect token, the network is taking the next step, paving the way for a fully decentralized, permissionless, and community-owned future of connectivity. Want to learn more? Follow at WalletConnect on X and Telegram, or visit walletconnect.network to stay ahead of what's next. As always, investments in blockchain technology involve risk, terms, and conditions apply.
Obviously, when Bitcoin sells off a bit, you're going to get a little bit of a pullback. But look at the top two performers today, at least on my watch list, are actually Syrup and Monero.
Ooh,
with nice bounces off the lows after their pullback. I mean, I think these are this is still a phenomenal time to get into the coins that you think are going to do well over the next three to 6 months. I think they actually haven't run as much as they could have, especially with Bitcoin's price. And unless Bitcoin completely collapses in on itself, and by that I mean go to back to the 80s, I think that we get a period where you will get outperformance from these coins, especially as they increase traction. I mean, there's something like Hyperliquid, right? Hyperliquid did really well, touched 40 almost, or did on I think maybe it did, but then obviously it comes off a lot, because what ends up happening with these hype cycles is people really crowd into trades. They go up 3-4 days in a row, 10-15%. And then obviously you get some profit taking. Obviously it comes back down to earth. And if you haven't positioned, that's a really good time to get in. So kind of where we are right now, at this moment, is actually, I think, a reasonable time to scale into altcoins. I think, taking out some trades here, or trying to buy the stuff that has sold off, but you still like, because Bitcoin went from 112 to 104. Now is a good time to take a little bit of a punt.
Syrup's looking good. I think we could get a 10 bagger on that one. I think that could be a nice 10x over the course of the next 7-10 months.
I think it will be. I mean, as long as I see that they're still growing in terms of TVL, I mean, these guys are raking it in. Same with Hyperliquid. And
yeah, I mean, to me, the most bullish possible thing for Hyperliquid, there's two things. One, Syrup is TradFi integrations. That's what you're looking for. Hyperliquid would be perps become legal in the United States. So talk about just general fundamentals improving. If perps, the perpetual future is one of the most interesting innovations, not just in crypto, but in modern finance. I personally think, having used them now, that it's probably the most important financial innovation since maybe the Black-Scholes formula for valuing options. I really mean that. I think it's an incredible idea. I don't know whether Arthur Hayes deserves credit, or somebody at that team, BitMEX, deserves credit. But basically, a perp isn't legal in the United States right now for, I forget what complicated reason, some CFTC rule. There's discussion in Washington of reversing that. And once perps become legal in the United States, which feels at this point inevitable, I think they'll kind of spread like wildfire to the rest of finance, and the platforms that are best situated to capitalize on that kind of proliferation are crypto platforms, because they're already managing perps. They already know how to manage perp risk, perp liquidations, perp trading. Hyperliquid will suddenly become accessible to US users. That'll onboard a lot of trading fees and volume and activity, and that'll feed into the price flywheel because of the buyback mechanism. So I wouldn't be surprised if in 6 months we see perpetual WTI futures on Hyperliquid and US users, including oil companies, trading it. Oil is just my litmus test for all things TradFi, because that's where I cut my teeth. In terms of the other big unlock for Hyperliquid, it would be a Solana integration, because Arbitrum is just a flaming pile of elephant shit. So I think, or even a base integration, but just more chains, right? I think more chains better for Hyperliquid, more users better, and it's all coming. So yeah, maybe it's a good pullback to get into things like Syrup and Hype.
I was curious about perpetual futures and how that actually got developed, because my understanding was that BitMEX was the first. Yeah, they were the first people to produce it. I mean, I remember trading their perps. I started trading on BitMEX in 2018. Actually, I would never trade on BitMEX because I'm an American. But if I were to start trading on BitMEX, it would have happened in 2018, when I got like into futures trading. But before that, I was really into Poloniex, because they had a good leverage mechanism. I blew up a few times there.
That was a 2017
2017. Yeah, I
remember that.
I remember getting long ETH BTC at the exact top, at like the literal forever I got long the forever top of ETH BTC, which I'll always be proud of. But back in 2017. But what's interesting is apparently Robert Shiller proposed perpetual swaps in 1992.
Oh wow!
And everyone was like, no, I don't know, this doesn't really make sense, because his version of the perpetual swap is a little bit more complicated. I don't think he had the concept of a funding rate, and so he tried to use all these other random costs to bake them into the future to just price them correctly. But I think what happened was, apparently in 2011, a guy named Alexei Bragin developed a solution to simplify leverage trading of cryptocurrencies for unlicensed exchanges. And he invented the funding rate.
Oh wow!
And then yeah, it was in 2011. Believe it or not, how crazy is that?
That is crazy. I had no idea. So I guess we can give Arthur Hayes and company credit for the proliferation of the perp. Yeah, exactly.
I mean, and they also, they did pioneer it across a variety of different assets. I think that they created their own version of the inverse perpetual swap, the paid out in Bitcoin version.
Yeah.
I think they
coin margined.
Coin margined. Which was the great and horrific thing about them, by the way. What's interesting is that they're not actually illegal, right? There's nothing inherent about them that's illegal. It's just that they're a new product. They're not under the purview of the CFTC, and there's been nobody, I think, except for Coinbase, which is trying to right now, work with the CFTC to introduce perpetual swaps to US-based users. But I feel like that's going to happen in the future at some point, and I also wouldn't be shocked to see in the next 5 years perpetual swaps come to traditional markets. Like, I'm really honestly shocked. Why has that not happened?
Well, let me tell you, it's that rule, right? Or lack of a framework that is the reason why it hasn't come to traditional markets. The United States is the golden shining city on the hill for futurized commodities markets and financial markets, as like financialized futures markets as well, like Eurodollar futures, interest rate futures, blah blah blah. So currency futures, it's all CME, NYMEX, ICE. It's all this big sort of US centric ecosystem. Sure, there are futures in Europe, and sure there are futures in Asia, but the United States is really the hub of that kind of trading, that kind of leverage trading. And yeah, if you've ever been a professional futures trader, which I have, and many people listening probably have as well, you're familiar with the concept of the roll. Every single month, you have to roll your prompt exposure, excuse me, into the next month. And if you don't intend to take physical delivery, or sometimes futures won't even require physical delivery, it'll just be cash settled, which makes no sense. Why would you want like I guess if you're a hedger, if you're a corporate hedger and you have exposure that rolls off your books on some specific date in the future, then you're perfectly happy to, if you're a commodities company, deliver futures into a contract, or if you're a financial company, just have your exposure expire on a certain date. So in the sense of hedging, it can be very effective to have an expiry date. But for speculators, there are two distinct nightmares associated with futures trading. One is the roll, right? It's a pain in the ass. All sorts of weird dynamics start to occur as you get towards expiry and OI drops. And the other is analysis of the data becomes like, yes, there are ways around this, but it becomes kind of complicated to go back and try to normalize all these different futures to one sort of rolling price history. And so I think that perps are a lot cleaner from the perspective of speculation. As far as hedging is concerned, you could certainly design instruments on top of perps that have exposure that sort of automatically decrements or rolls off or minimizes itself on certain dates into the perp future, funding contingent stuff. Like, there are lots of like structures you could build on top of a perp in order for hedgers to feel comfortable using it. But from the speculator's perspective, the perp is sort of the optimal instrument for all sorts of markets. So I don't really know why, like a currency future, for example, has a tiny fraction of the volume of the underlying spot pair. So I would imagine for assets where spot is a more important thing to speculate on than like basically dated exposure, expiring exposure, which is probably most markets, and where spot isn't readily available. So FX will be fine because you can easily access spot, but I think perps will really proliferate. I think perps will eat the market share very quickly. And I don't expect the CME to be like at the bleeding edge of that innovation. They suck at that stuff. It's going to be things like Hyperliquid, like Coinbase, if they get their act together. I think it might be one of those crypto native use cases that onboards users.
Yeah, I mean, from my perspective, everything that doesn't require physical delivery or anything that's outside of the realm of commodity, the perpetual future is a better product, right? If it's not, if you don't have, I say natural users of, producers or people that are okay. I'm a farmer. I want to hedge my corn crop in for this year. Right? As long as you don't have a huge amount of those people in the market, perpetual futures are going to be much better, right? So if you're thinking about like the S&P, like the E-minis, right? It's like, why not have those?
Yeah, why have an expiring S&P exposure? It's ridiculous.
Why, right? There's kind of no reason for that, right?
Yeah. Equities, that's market number one. Market number two is interest rates, like a rolling 2-year swap, basically 2-year interest rate exposure or 5-year interest rate exposure. It's just it's a nightmare to deal with treasury bonds, but you could easily design a perp based on a certain interest rate tenor and then have the funding mechanism keep the perp in line with whatever the prompt cheapest to deliver underlying future is, without having to deal with all the mechanics of expiry and annoyance there. So I think that could be a big use case.
What's kind of cool is it would also give us another indicator to look at for positioning in the markets.
Yes.
I mean, in theory, all of these products obviously would trade at a negative funding rate to begin with. A negative meaning the buyers get paid because they all have dividends, right? So
yep.
So there can't be any arbitrage there. Short that by the underlying collect the dividend. That's going to get arbed out. You're going to have to pay to short the thing.
Yep.
In the beginning, but it would give you kind of like an interesting dynamic there. It's like if the funding rate goes very negative versus the dividend, that a lot of people are betting that the market's going to go down.
That's interesting.
And it would be real time, right? One thing that people really underappreciate about the crypto market is just how much information and data we get to trade this thing versus the traditional markets. I mean, like basically anybody can go log on to Velo data and see, okay, in the last 15 minutes, who has like how much leverage has been added to the system? What is basis, right? You need to actually pay a lot of money to get that. And some things you can't even get, right? Like the fact that basically every exchange you can just stream their order book data is crazy.
Yeah, it's
That's very expensive if you want to get that from any other exchange. They're gonna charge you an arm and a leg for that, especially if you tell them you're a professional trader, which I always found was funny. It's like if you tell them you're a professional trader, you just oh, you work at a bank, you're paying a lot more, buddy. I mean, it makes sense. Like they make a lot more, but I just thought it was like, it's funny. They always ask you.
Yeah, I hate that. I hate feeling like I'm getting scammed. Like if a service costs X, you shouldn't pay more because you have more money. That's charity. That's not business. Anyway, sorry, side tangent. Yes, I agree. This is why crypto is the golden asset class for retail, because you can have access to leverage. You can have access to hyper, like optimized financial instruments like perps, where you can get long and short something without having to worry about delivery mechanics, with amazing data, high leverage, just by yourself in your pajamas in your bedroom, right? You can access information about the product on Discord, Telegram, Twitter, and podcasts. And, you can find it basically like a virtual online trading floor. And it's not just this like weird niche gambling market. It's not baseball cards. It's not online poker. It's becoming geopolitically relevant, and it's not completely orthogonal to other financial markets that matter, like as we've seen during the tariff pullback. We should probably touch on macro at some point in that vein later in the podcast, but like this is why it's the golden market for retail. And one of the biggest mistakes I've ever made in my career was thinking that I needed to work for a company to trade crypto, like, because that's an obvious conclusion if you trade any other market. Like, no, you're not going to be a successful gasoline trader in your pajamas from your bedroom. But yes, you will be much better positioned, and the odds will be much more in your favor if you work at VTOL, right? To trade gasoline. But the same doesn't apply to crypto. In fact, the opposite is true. Like it's kind of a constraint to have all sorts of random risk controls and exposure limits and platforms that you can and can't farm on and whatever. So yeah, crypto is the golden asset class for retail. And I think that crypto, like instruments like perps, and other, so many of these other like innovations, such as having all this data on chain for everybody to see, will democratize other markets in time. And yeah, I think you're right. Equities and maybe interest rates will be first to go. It would be, what would Hyperliquid be valued at, Avi, if TradFi starts trading equity and interest rate perps on Hyperliquid? That would be insane. That would be freaking crazy.
It's entirely possible. It genuinely is possible, which that's why I'm excited about this stuff, and that's why I'm excited it's down. It didn't immediately teleport from 40 to 50, so I can buy a little bit more.
When executing large crypto orders, discretion and efficiency are key. Kraken OTC is built for high net worth individuals and institutions who need deep liquidity, seamless settlement, and 24/7 access to expert traders. Trade via chat or request fast, automated quotes for orders over $50,000. Visit kraken.com/blockworks to learn more. Availability of products may vary by jurisdiction, not investment advice. Crypto trading involves risk of loss and is offered to U.S. customers through Payward Interactive. View legal disclosures at kraken.com/legal/disclosures. WalletConnect is the connectivity network shaping the future of on-chain UX. If you've connected to a Web3 app, you've seen WalletConnect, an icon of trust in crypto, as recognizable as Visa at checkout. From DeFi to NFTs, swaps to staking, WalletConnect is the backbone of connectivity in the on-chain economy, seamlessly bridging wallets, apps, and blockchains. Over 250 million connections and 40 million users worldwide have trusted WalletConnect. And now, with the launch of the WalletConnect token, the network is taking the next step. paving the way for a fully decentralized, permissionless, and community-owned future of connectivity. Want to learn more? Follow at WalletConnect on X and Telegram, or visit walletconnect.network to stay ahead of what's next. As always, investments in blockchain technology involve risk, terms, and conditions apply.
Why don't we touch on macro? I mean, the equity markets have kind of stagnated here. One thing that is worrying me is that gold is starting to do very well again. And yeah, it's up 2.5% today.
Yeah.
And to me, and the chart is looking gorgeous.
That's on the Russia attack. Same reason oil's up.
Yeah. But that, it's I think a little concerning to me that we're seeing that on a day. Basically, equities haven't gone anywhere for 2 weeks. They've just gone completely sideways for 2 weeks. So what do we make of this Russia attack? What do we make of its impact on the markets? What do we make of what's going on, Jonah?
Yeah, I mean, okay, so for those who missed it, the Ukrainian special forces loaded a bunch of AI enabled drones onto trucks, basically containers on trucks that were driven deep into Russia, either unbeknownst to the Russians by Russian drivers or Ukrainian agents, or we don't know who. And then all these containers just sort of opened up, and the drones came out and blew up a very concentrated grouping of Russian nuclear enabled bombers, which were all clustered at this airfield, but hadn't been recently, but we're getting clustered there as some sort of gambit by the Russian army, planned gambit that obviously got foiled by the bombings, the drone attacks, planned gambit to drastically escalate the Ukraine war as a pillar of peace negotiations. So basically establish the upper hand, then sort of anchor the negotiations, more in your favor by doing so. That was sort of what happened, and it got foiled by the Ukrainians, and now the Russians are really pissed off. Who knows if it's real or not, but there are all kinds of menacing Russia, Russian military watching accounts on Twitter posting the Russian military is pointing nukes at Washington and London and New York and all sorts of scary, horrible things. Basically, geopolitical uncertainty is up on this because it's a massive humiliation for Russia and their, strongman culture. They're going to either retaliate or saber rattle. So that's why gold is up. That's why oil is up, despite the fact that it should be down on Saudi threatening to increase production to punish Kazakhstan for cheating. Basically, the geopolitical risk factor is up massively. And what I think that should do in the short term, first thing that happens when geopolitical risk goes up is gold spikes. Bitcoin acts more like stocks than gold in that environment. But then I think what Bitcoin isn't a geopolitical risk hedge. It's a hedge to what governments do to mitigate the financial impact of geopolitical risk, which is governments ease financial conditions and then Bitcoin sends. So I think that's probably what we're going to see again. And if we don't, it's because Russia's nuked the world and brought about the end of days. So who cares? Buy Bitcoin.
Yeah, the one important point on this Russia issue is that the Ukrainians checked with the United States before they launched this attack. And for a long time, it was thought that the United States, with Trump in charge, would be very, kind to Russia. They would basically work with the Russians and with the Ukrainians to try to come to a ceasefire and not give the Ukrainians as much leeway as the Biden administration did. And I think what we're seeing right now is we're seeing Trump's fatigue with Putin. He's starting to realize, okay, I'm actually not getting anywhere with this guy. So if Ukraine calls and says we have this plan, it's going to really piss off the Russians and could escalate the war. For Trump to say yes, go ahead, instead of no, hold on, we're literally about to have a peace talk. The delegation, the Russian delegation, was in the air towards the summit while this was happening. It signals escalation, which is why gold, as you said, is up 2.5% today. That's a 2.5%. By the way, is a big move from gold. That is not a small move in a day. That is saying something significant. What is more shocking to me, genuinely, is that the S&P is flat with gold up to 2.5%, because gold is taking this very, very seriously. The markets are not, which really just says, to me at least, there are two possibilities here. The first possibility is that the equity markets don't necessarily can't appreciate what's happening, because in a world where the equity markets are affected, that's a world in which the war expands, and nobody wants to bet on that, because it just means equity markets are down like tremendously. So either it's like -30 or here.
It's binary.
So it's like binary. It's like a binary choice, and the markets aren't really reacting to it. Or just the other thing here is that as the war over there heats up, the divisions between countries are going to get even stronger, and sides are going to need to be chosen, and the multipolar world comes even faster. In which case, countries are going to need to really stockpile gold to be relevant in this world. So I think it's more likely that's what's happening. Is geopolitical risk. Countries are going to stockpile gold. Let's pile into this. I'm not necessarily saying that the war is going to expand massively.
Yeah, I think that's the right take.
But I'm still giga bullish on gold. I mean, I have been for a while. I did sell out of my gold a while ago. I bought back in basically around the same price. Didn't really make much on that. But I did buy equities with the sale proceeds. So I guess I came out on top. But I just recently sold some equities to buy back some gold here.
Yeah, the mega trend in gold is certainly intact. I mean, it's
just look at. By the way, just go look at the 3-day chart. It's so sexy.
Yeah,
it's just like the most beautiful chart ever right now. It's like, when does this thing stop?
I think the most beautiful chart is the long-term chart. I mean, look at it. It's like, it's basically been up only since October 2023. Yeah. Oh no, sorry. I guess, okay, fine. It flatlined for summer 2023. No, yeah. It's basically October 23 onwards. It's just been up only. It's the most smooth, high, sharp thing to hold on to. And I think that's going to continue. I wonder why, and I want to get your take on this, Avi. Why do you think it is that in any one of these geopolitical risk scenarios, Bitcoin sells off and then immediately spikes back? Like, do you think it just feels like the market hands you an opportunity in crypto every time there's a geopolitical scare? Because obviously the next thing that happens is governments talk dovish on financial markets and Bitcoin rallies. Multipolar world, like, that's going to be a little bit rough on the ecosystem of trad financial companies. So China and the US will both be pumping stimulus if the economies separate from each other, they get a divorce, right? So like, I feel like these V-shaped dips won't keep happening forever, and we're just in this phase where people haven't wised up to the fact that Bitcoin should behave like gold in a geopolitical flare up. And so it's kind of an opportunity for people like us. I don't know. What do you think? Like, eventually Bitcoin will just go up. It won't give you a dip to buy, is my point.
Yeah, I mean, I agree. Let me stop you there. I agree with that statement that Bitcoin does go up in that scenario after a bit, and that a substantial dip is meant to be bought, but it dips, I think, because of flow issues. It dips because the equity markets are going to dip, and Bitcoin is traded very heavily by macro PMs, and this is especially true if something happens over the weekend. There's nowhere else to go. You sell Bitcoin. Like, if something significant happens and you want to bet against the equity markets, that there's like some level of correlation there. Russia gets attacked on a Saturday, you sell Bitcoin, and then you even it out when equity futures open, right? And then Bitcoin can get a bounce. So I do think what can happen there is, because there are correlation traders that send down the price, and Bitcoin is a very momentum driven asset, Bitcoin will go down. Because of the correlation traders. The correlation traders will sell, and then everyone else is like, okay, well, I'm sitting on UPNL and Bitcoin can move down 10% in a day. Let me just get the fuck out. Which I kind of like. I'm a little nervous that's what's happening right now. I mean, generally, I know this is like, this sounds really silly, but just if you draw a line on the on the Bitcoin chart, we've been in a sustained uptrend since the beginning of April, and we just broke it. And people buy momentum and value. That's the framework that I always point to. Right now, you kind of have neither, unless you get some good news out of the Bitcoin world, which is very possible. But yeah, it's like, I think we're chopped to lower without news right now. I do think that there's probably a floor at 97. Maybe we can trade there and pop back up. But like I said, I'm definitely not. This James Wynn guy, I think is in trouble. Let's put it like that, because his liquidation price is like $1,000 lower than here.
I don't understand why people do that. I guess I do. It's just a gambling addiction. It's terrible trading to do stuff like that. It just goes to
they want to gamble. Let them have it, Jonah.
Fair enough.
Let them gamble. Don't complain about people gambling. That's our whole livelihood, is taking the other side.
That's true. Gambling is fun. And speaking of taking the other side, look, if people sell Bitcoin into oblivion because there's bearish news on a weekend, unless that news is so impactful that it's going to send the market lower over the medium term, that's just a phenomenal opportunity for anyone who wants to take the other side of that trade. Like, stuff like that happens all the time. Like airline companies will hedge jet fuel. They'll buy deferred jet fuel futures, meaning they expire far in the future, right? They'll buy those futures to hedge their jet fuel consumption at levels that are way, way, way above the levels at which jet fuel actually realizes, right, in the prompt. So anybody with enough risk capacity to take the other side of consistent flow that puts short-term hedging needs ahead of long-term, like, mathematical realities is a winner, right? It's a great trade if you can stomach the variance. And I think the same thing probably goes for people who use Bitcoin as like a weekend panic button. Unless Russia's actually like sending the missiles west of Kiev on a weekend, in which case don't buy the dip. Maybe these dips are meant to be bought. And to your point about Bitcoin maybe going down to 97, like, if it does, kind of hope it does, so I can add some exposure to things where I still feel a little bit light. Even Hyperliquid, I would probably, maybe Syrup, maybe Hyperliquid, maybe that's an opportunity to just like sell some, either take cash and add more to crypto, or sell equities or things that I don't expect to 5 to 10x and roll it into things that I do expect to 5 to 10x. Because I'm starting to get greedy here. Like, I think that we are in a phase where volatility and uncertainty are keeping markets contained below levels where they should ultimately price, given the regulatory and macro backdrop. And so that's why I'm excited to buy crypto at current prices, because I think the volatility is short term, it will fade, and the long term fundamentals will continue to improve. Basically.
I think that's a great note. Crypto looks good here.
Yeah, it looks good here over the medium term. Short term, I agree with you. It could keep chopping.
Earlier in today's episode, I mentioned Ledger's latest products, the Stacks and Flex, and I wanted to take a few seconds to tell you more about them. These wallets feature the world's first secure touchscreens, which don't just simplify your digital transactions, but also keep them extremely safe. These wallets are virtually impenetrable to online attacks because they store your private key in a secure offline chip. You can manage more than 5,500 tokens and install up to 100 apps. Choose the most trusted name in hardware wallets and take control of your digital security today at ledger.com, or hit the link in the description of today's episode to check out their latest wallets. As always, investments in blockchain technology involve risk, terms, and conditions apply.
Here's a question for you, Avi. On the Velo chart, so let's go to velo.xyz/futures/BTC. So let's look at Bitcoin. I would have, I was wrong about something, and I want to own up to it. I thought that we were out of the leverage woods when Bitcoin was on the highs, and I was wrong. Like, I think there was a little bit too much leverage in the market when Bitcoin was trading above 110, which obviously unwound. And the way that I judged that was I looked at the BTC funding rate, right? And I sort of looked over a 3 to 6 month timeline. So let me put 6 months in here. What crazy funding is what you see. Actually, let's go a little further back. Let's go to a year. Crazy funding is what you saw around the election when, like, forget Hyperliquid, maybe when Bybit funding was 42%, you know, when people were just like seeing green, they could without really thinking. And I was like, oh, well, we're trading 112 and, you know, like the funding rates are only, okay, Bybit's 8.4%, OKX is 3.5%, Binance is 3.5%. These funding rates aren't crazy. I guess the market's not too levered. What was I missing? Because obviously leverage has come off.
So this is actually quite simple. Notice how, okay, we'll go to the bottom, right, of the Bitcoin chart where it bottomed out. I'm on the 12-hour chart here. So bottoms out at 74K. We have, you know, 173,000, let's call it 170,000 in aggregated open interest. This is counting on Bitcoin in Bitcoin terms.
Across all exchanges.
From across all exchanges. From there, all the way to May, we added about 15,000 coins. At the peak, we added 36, but then you see how this comes off really quickly. Yeah. So even to the peak, we only added 36,000 coins. And remember, prices are lower. So you see how open interest doesn't really go up a ton here. Yes, obviously it goes up, and there are some spikes that immediately get sold back down into, but open interest doesn't go crazy.
Yeah.
Now, go now to 18th of May. Bitcoin price goes up from 102,000 to 111,000. That's only $9,000. It's a 9% move. The move before, 40% move. So for a 40% move, you get 15,000 coins added in OI. For a 9% move, you get 40,000 coins added in leverage. It's all about the ratio. You basically take the number of coins and you divide it by the price movement. And if that ratio is like 2 or 3, then you're in a danger zone. Like, you're like, okay, I don't know how sustainable this move is going to be. Now, look, immediately Bitcoin loses it. And this is key, by the way. So Bitcoin goes sideways, loses its momentum, and open interest stays flat. That means nobody is now willing to add to their positions. There are no more buyers.
Funding is just eating their money.
The guys that add all of this leverage are generally the last buyers of a rally, right? They're the guys that are like, I didn't make enough money from here to here. I'm going to make all my money in this tiny little section over here.
Yeah.
So they go crazy. Now, then it goes, once it starts going sideways, you know, all right, I got to get the fuck out, because these guys are going to have to come off at some point. And look, that's what it does. And to be fair, this isn't, you know, it's not a huge move. It's a 7% move. But you know, so I'm not saying, oh, you have to short every time this happens. I'm just saying, maybe lighten up, maybe don't buy. You see this, maybe you're not buying.
Yep. No, that's
you see that, you probably don't want to buy a ton in that area where that happened. You want to wait a little bit for it to come off. You can short. I think you know, there are ways to tactically short, and generally my rule of thumb is I don't buy until all of this goes away. So I'm not buying until we get back down, you know, to here, basically
190.
You know, we need like another 10, you know, like another 10,000 13,000 coins come off. Maybe that takes us down here to 97. And then if we're at 97 and all of that is down, then I'm buying a fuck ton of alts. Right. So this is a little bit of how I think about it.
That is a very clear and very helpful representation of how you look at this. That's awesome. Thank you. So, okay. So basically, Yeah, all right. I guess my mistake was I was too focused on funding rates and not looking at open interest enough.
And actually, we can go back and look at the funding rates. The issue with funding rates is that you often look at them over time, but what matters are the spikes. So
Yeah.
let's see if I can. I'm gonna go back and share.
Can you
So
share? Is
it's
it
a good
possible for
point.
you to share your? Yeah, let me here add to the stage. Is it possible for you to share your Velo screener, like just the way that this? I think maybe our community in the Niger Delta Avengers chat would appreciate
It's
having.
very easy. You go to indicators and you just click open interest and aggregated funding and just like aggregated. There are all sorts of
see.
other amazing things here. Basically, anything with Velo in front of it is specifically Velo. Anything below.
Oh, you're
here
doing
is
this in
just find their
Trading
own.
View.
So this Velo has Trading View integrated.
Yeah, I use their web app, but yeah, fair enough.
So you see how you get these funding spikes here. You don't.
Yeah.
That's not great either. Yeah,
I just thought that
you don't
funding
really
spike was
want to
so
see these
minimal
massive
compared to what we saw
spikes
during the
because
election that I kind of dismissed it, but I shouldn't have.
It's minimal, but it's also because there's a lot of money in the markets arbing out these funding rates. So
Yeah.
the funding rates they don't get elevated for a very long time. So what is the point of a funding rate spike then? Like, why do I care about a funding rate spike? The funding rate spike tells me that I'm not just imagining that this open interest is long.
Yep.
Right? Because open interest, obviously, it has to go both ways, right? Like for every long, there is a short. But generally what's happening is that market makers are offsetting one of the sides, right?
Yep.
So it's the takers that really matter. So when you see open interest go up a lot and then, okay, funding rate has spiked, that means that open interest is going up in all likelihood because there are aggressive takers buying, getting long positions, and then there are market makers that are taking the short side and then hedging out the risk.
Yeah.
So net, you still end up reasonably long, right? So that's why the funding rate spikes are important. I don't actually use funding at all anymore, except to confirm direction of open interest. Otherwise, it just doesn't really make sense to use because of all the people that are orbing it. There's so many people that are just taking that'll just take it back to neutral for free money.
No, that's a great point.
Because really, like all it requires is a balance sheet. You can do it all day. It just requires a balance sheet. And there are enough people here that have a balance sheet. The reason that, a guy with $2 million isn't doing it because if they take $1 million position, they can get liquidated.
Yeah.
But you take a $500 million position, arbing out funding rates across a bunch of different instruments, and you have 1.5 billion on your balance sheet, and you have a relationship with the exchange, and they're not going to liquidate you without allowing you to top up more capital, which happens a lot more than you think. Then you can do this all day.
One interesting phenomenon is that those funding rates are where they are because of interest rates in general, right? Like, let's say that the Fed reduced the short-term borrowing rate from wherever it is now, 4-ish% to 0.
Mm-hmm.
Those funding rates would come in a lot. They'd go down because TradFi institutions like my former employer, as well as its competitors, they borrow capital to do this trade. Or even if they don't borrow capital and they're just sitting on a bunch of partner capital, they have to evaluate the opportunity cost of deploying capital into a crypto basis versus the other opportunities they have on the table, which are plentiful. So there's sort of like a internal funding threshold below which you don't go for opportunities and above which opportunities start to look interesting. So, if you can earn 4% on T-bills or 4.1% on T-bills, you're not going to try to earn 3.5% doing a Bitcoin basis trade on Binance, because that's inherently much, much, much riskier than doing a T-bill. But you would go for a 20% arbitrage on Binance after the election. So basically, that speaks to your point about the funding spikes being short-lived, and it also gives you a sense of like where the general TradFi, like deep-pocketed crypto basis arbitrage crowd has their break even. Like, it was part of our spreadsheet at Cumberland. We would literally be like, oh, okay, like money costs us 10%. So we're not going to go for opportunities that are less than 10%. And that 10% cost, I'm just, making up a number here. It was obviously different than that, but that 10% cost included the risk-free rate, as well as the opportunity cost of other opportunities, as well as like capital constraints within the firm, et cetera, et cetera. So it was very, it was a moving target, but it was there. And so maybe that's why funding doesn't spike for very long, because all those people have like powder in the gun, ready to do their basis arbs when funding spikes too much. So I take your point about funding being a good like bleeding edge indicator, and then open interest really telling you when people are over their skis or not.
100%. Okay. I think that was fun. That was the first time I did a screen share and taught you guys something about how to trade. So I hope you guys enjoyed it.
I did.
We'll do more of that in the future. Maybe we'll give a few lessons in the future about how I think about trading.
Masterclass.
Yeah, Jonah, this was awesome.
This is great. Unexpectedly busy episode. Great talking to you, Avi, as always.
Yeah, this was a pleasure, Jonah. All right.
See you next week.
Talk soon. Take care.
Nothing said on the 1000X podcast is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the company's funds or projects discussed.